What's going on, guys? In this video, I am going to teach you the benefits of dollar cost averaging. First, I'll explain exactly what dollar cost averaging is, show you what it looks like on a chart, and then we're actually going to jump over to Google Sheets and I'm going to show you some real life examples if you were to dollar cost average over the course of 1 year, 5 years, 10 years, and 20 years. So first, let's jump over to ChatGPT and let's say explain dollar cost averaging in simple terms. So let's get a quick answer right here. Dollar cost averaging is a strategy where you invest a fixed amount of money regularly rather than a lump sum in a volatile environment, example stocks, to reduce risk. Over time, this averages out to cost per unit of the investment, potentially lower than the overall average cost. And that is exactly true. So if we jump over to TradingView, if you were to dollar cost average into the S&P 500 in the past year, let's say you split it up each month. So you're going to be buying 12 times at whatever the price is. And remember, it's going to be a fixed cost. So it's not like you need to buy the same amount of shares or any of that. No, you just determine your fixed cost. And every single month where these check marks are, you're just hitting that buy button. So let's say it's $500. We're going to be buying $500 in January, February, March, April, May, June, July, August, September, all the way up to December. And at the end of the year, we'd be investing $6,000. And you keep doing this regardless of what the price is. It takes thinking out of the equation. It takes emotions out of the equation. It takes timing the market, and that's the most important one. People suck at timing the market, and people lose so much money trying to time the market. So with dollar cost averaging, you're buying at highs and lows. You don't care what the price is. You just know that you buy into a high quality ETF like the S&P 500, and over time, over the long run, the stock should go up. This is over the course of about 30 years. Here's the dot-com bubble. Here's the financial crisis. Here's COVID. Here's the year we just had. But overall, the stock goes up. So if you were to dollar cost average over the past 30 years from the highs and the lows, you would end up sitting at a pretty penny and you'd be pretty happy with what you did. So let's jump over to Google Sheets. I'm going to show you some actual examples. I'm going to take the real numbers of the S&P 500 and what it would look like if you invested, say, $500 every single month over, you can see down here, 2022 to 2023, 2017 to 2023, 2013 to 2023, and 2003 to 2023. So you got 20 years, 10 years, 5 years, and 1 year. And the results are pretty cool. But first, again, if you're new to it and you really don't know how much money you should invest, I'm not saying throw everything you got into it. And this isn't a big lump sum of money. The point of dollar cost averaging is you're just putting a small amount of your income into an ETF over time. So you don't have to worry about dumping 100 grand into it and then the market tanks and you just lost all that money and you're going to come back and write a mean comment on this video. And before we keep going, remember, this is not financial advice. This is purely for education and entertainment purposes only. Do your own research before you invest. But let's say you need a starting point. How much money should I invest? I would encourage you to do this. What's your monthly salary? How much are your monthly expenses? Figure out what your total expenses are, and then what's left over. And then from what's left over, pick what you feel comfortable with investing. This is just a real general fake thing that I've written up, but you kind of get the point. You have rent, maybe you have a car, you have car insurance, you got to buy food, you have subscriptions, whether that be Netflix or Spotify, Apple Music, whatever it might be. Put that all in. And then entertainment, you're going to want to live your life and have fun. So obviously, you got to account for that money as well. So how much money does it cost for you to live month to month? Let's say in this example, for this person that's making $5,000, we're going to say this is net, so after taxes, they're left with $4,000. Well, they're left with $1,000 because it costs them $4,000 to live each month. So with that $1,000 left each month, they decided, let me invest half of that, $500, and then maybe the other 500 could go into a savings account or an emergency fund. And I didn't just pick 500 out of thin air. That's usually what people invest into a Roth IRA. So I personally would encourage that. So maybe look into Roth IRAs, because then you could take advantage of not having to pay capital gains tax when you could finally cash out by the time you turn 59 and a half. But let's look at the first example. So if you take that $500 a month, that's in cell C, your contribution, and this is what the current price was for the S&P 500 at all these dates. So I just did the index Google Finance function, SPY, what the price was on cell A3, so on 1/3/2022. That was the price. It was $477. We're not going to go and check everything, but I'll just show you the first one. So if we go to January, let's zoom in. See, January 3rd, the closing price, $477. So that's how I'm doing it. So we don't have to actually go through everything. I just have it all nice and laid out with the Google Finance function. Here's each price at the beginning of the month, every single month for 12 months. The entire year last year, if you're contributing $500, here's how many shares you're going to be getting each time. So it's a fractional share. There's plenty of brokerage accounts that offer you to buy fractional shares. There's Robinhood, which everyone knows. Fidelity offers you to buy fractional shares. It really annoys me that TD Ameritrade does not have fractional shares, but whatever, you can't win everything. So you could see in January, we were able to buy 1.5. And obviously, the price has gone down in the past year. 2022 was a bad year. It started at 477 and went all the way down to 399. So we're down roughly 18% for the year. But you could see we're contributing the same amount, and the amount of shares we could afford slowly went up. So even though we're not trying to time the market, we are able to buy more shares at a lower price than what we're buying at a higher price, which is pushing our average buy price down. So you could see at the end of the year, we have a total of 14 shares, a little over 14 shares. We contributed $6,000, and our average buy price was $411. If we scroll over, the current price is $405. Your value did go down a little. We lost 83 bucks. Our profit or loss, were in the hole a little over 1%. But you got to remember, that is not bad at all, because if we jump back to the S&P 500, since the beginning of 2022, let's zoom out, until now, we're down over 13%. So the market, if you were to just throw a lump sum in here, and then you're down 13%, that's going to hurt a lot more than just being down 1.39%. So now let's look at, what about if we did, now I jumped over the past 5 years. So from 2018 all the way to 2022, you were contributing $500 a month. And you could see the shares, here's the shares over here. We have a total of 90 shares now. Over 5 years, we've contributed $30,000. Our average buy price was $330. The current price is $405. Our value is now $36,000. So we've made over $6,000, and we're at a profit of 22%. That's looking pretty good. It just keeps getting better. Let's look at the past 10 years now. So this is 2013 to 2023, and you can see it's the same exact chart. I'm just adding the years. We now have a total of 241 shares. Our contribution is $60,000, and our average buy price was $248. So you can see here are the results. Your value would be $98,000. You would have a profit of $38,000, and your profit and loss would be up 63%. And now the very last one, how about if you were to invest 20 years? So here's 20 years worth of data, $500 each time, just regardless of what the price is, every single month, you'd have a total of 750 shares. Contribution would be $120,000. Look at your average buy price, only $159. If we scroll over, your value would be $304,000. So your profit would be $184,000, or you would be up 153%. That's incredible. That's not trying to time the market. You're not trying to beat any hedge funds here. You're just simply buying every single month, regardless of what the price is. So you're going to be buying at highs and lows. And over time, you can see right here, you'll make money as long as the stock market goes up. And over time, it does. So you don't have to worry about the volatility. You don't have to worry about getting in at the right price because you're just getting in at every price. That is the point of dollar cost averaging. It is so effective over time. There's tons of articles, tons of research, tons of studies and experts who would all tell you dollar cost averaging is one of the best things you could do. And the coolest part is it's so easy. You hardly need to know about finance or investing other than how do I set up a brokerage account and how do I put money in and hit buy every single month. That's it. Very simple. And over time, you can make a lot of money this way and then have a real great retirement and live comfortably. But guys, if you liked this video, if I was able to help you understand dollar cost averaging better, please smash that like button. Subscribe if you want to. And guys, as always, I will see you in the next one.